me, is 62,000 a reason to turn bearish on Bitcoin? I mean, if you're trading it, yeah, but Bitcoin was $1,000, well, $100 10 years ago. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving. I don't think it moves. It's still a risk on assets. So I don't expect it to do well if the market is being hit by tariffs. Like, it's not immune to that kind of turbulence. But is the trust around Bitcoin going to grow over the next 5 years? Yes. And is it going to be increasingly viewed as a store of value like gold? Yes, I think increasingly. And then is there room for a lot more people to own it? Yes. So I'm not really bearish on it, but I think in the near term, it's hard to say it should go up right now. Solana, Ethereum, and Bitcoin all have downside. He has been bearish since mid-January. So I think it's been correct. And his downside target for Bitcoin is 62,000 by the end of March.
According to Jong Lee, head of research at Fundstrat Global Advisors, Bitcoin could hit 250,000 by the end of 2025. Despite recent fluctuations, Lee maintains an optimistic view of the cryptocurrency's long-term prospects. Lee acknowledged the possibility of a short-term correction, but stressed that such volatility is typical for Bitcoin. Lee noted that Bitcoin is down 15% from its highs, but said it is a volatile asset and this is a normal correction. Lee highlighted key support levels, noting $70,000 as a critical threshold. If Bitcoin falls below $70,000, he mentioned that the $50,000 level could be tested. Despite these short-term fluctuations, Lee remains confident in Bitcoin's future and predicts that it could reach between $200,000 and $250,000 by the end of 2025. The current price, around $90,000, is considered a good entry point for long-term investors. He doesn't think anyone will lose money by buying here at $90,000. If they try to this time, perhaps they'll get lucky and the price will reach $70,000. He believes that Bitcoin will be one of the most notable assets in 2025, underscoring his optimism about the cryptocurrency's long-term performance. According to Jong Lee, if you want to retire as a multi-millionaire, hold Bitcoin for a long time. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Rahul Pal's view on Solana and the overall crypto market.
I'm going to say, I think the Feds, in terms of guessing their thinking, I think they view tariffs as an inflation risk. And that's governing their actions. But it's evident now that tariff risk is actually deflationary because it's sapping consumer confidence, and consumers don't actually have wallet share to pay for higher prices. So it's going to create a demand decline, which is recessionary. The market's only pricing a 27% probability of a cut in May. And by the way, the bond market's also, if you look at distribution, pricing a 23% chance of a Fed hike. So there's still a very large cohort that is quite hawkish in the bond world. I would guess that as this tariff stuff causes confidence to fall down and Doge, et cetera, that 23% chance of a hike goes to zero. But I also think the odds of a May cut should be higher than 27%. You can't really expect the stock market to go up if there's tariff talks, because then the administration would believe the markets aren't taking it seriously. So I think the White House would rather see the markets tumble or be under pressure from tariff talks. If we said, if the price of this falls, does it create a recession? Okay. Bond prices falling, probably say no. If gold crashes, we'd probably say no. But if home prices crash, definitely a recession. If stock prices crash, I'd say it's very likely to cause a recession, right? So, it's the sources of a market-based recession on price would be from housing or stocks.
It's not easy to predict the twists and turns of the stock market. Most people are wrong. Wall Street is littered with predictions that didn't come to pass, especially in late 2022 when stocks were mired in a brutal bear market. The consensus view at the time was that stocks would continue to fall, driven by a hostile Federal Reserve and slower economic growth. Few were willing to be optimistic, given that a beating sent the S&P 500 tumbling 24% between the end of 2021 and the end of September 2022. Still, not everyone was surprised by the rally that catapulted stocks to back-to-back 20% returns in 2023 and 2024. Among the most optimistic ahead of the stock market's stunning gains was veteran Wall Street analyst Jong Lee, who has been navigating the stock market since the early 1990s. Lee and his team at Fundstrat have been beating the bullish drum all year, most recently predicting in December that the S&P 500 would hit an all-time high of 7,000 in 2025. Things are changing fast, though. When it released its outlook, the Fed was still expected to agree to interest rate cuts this year. Not so much. Most expect the Fed to sit on its hands this year due to persistent inflation, which is bad news for corporate earnings. As a result, uncertainty has set in and stocks have become more volatile. The recent action caught Lee's attention, prompting an upgrade. After a 24% rise in 2024, we've seen some bumps in 2025, including a 2.5% drop in the S&P 500 ETF and a 3.5% drop in the tech-heavy NASDAQ 100 ETF since February 19th. The fall in tech stocks was especially stark for large caps, especially those that are part of the Magnificent Seven. Tesla stock has fallen more than 8% over the same period, and tech giant Nvidia has seen its stock drop 10% since its peak earlier this month. Needless to say, this raised some eyebrows, especially since tech stocks make up more than 30% of the S&P 500 and were a big reason for the stock market's epic run to all-time highs this month. However, stocks don't go up in a straight line. Pullbacks are frequent, and investors can't be held responsible for some of the gains, given the all-time highs that have been reached. Taking a step back, the long-term chart of the S&P 500 will look like a steady trend of gains. According to Lee, the U.S. stock market is very likely on the verge of an uptrend despite its recent correction. Lee says that in the face of tariffs and political uncertainty, markets always seem to be climbing a wall of worry or the tendency for assets to rise despite negative sentiment. What really surprises us is that the market has been hinting at extended periods of weakness because investors are bearish at the peaks, when there is record liquidity on the sidelines. So for us, this is a market that is very skeptical of these new highs. This downtrend and concerns about tariffs mean there is a wall of worry, so it is actually a very positive setup for stocks. Regardless of the recent volatility and perceived risk, the seasoned investor says growth stocks will continue to outperform this year, and the latest market correction will likely be shallow and short-lived. Investors really want to own stocks that have real structural advantages, as evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. The reason growth stocks will continue to outperform is that in a period like this, if we have macroeconomic uncertainty, these will be names of some visibility. It's not fun to own growth stocks today, but we know that the lesson of 2025 is that those pullbacks were not deep and investors bought those dips. So you don't think today will be any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So you think this will be a buying opportunity.